Welcome to Stewardology, a podcast where two worlds collide. In this show, financial advisor Tim Russell and Reverend Drew Gysi come together to explore the intersection of financial stewardship and theology. Their unique perspectives help Christians and churches understand and apply a biblical framework for everyday financial decisions, so Christians everywhere can improve and strengthen their walk with Christ through biblical stewardship. Before we get started, we just wanted you to know that the topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genuous Wealth Management, member FINRA and SIPC. Without further ado, here are your hosts, Tim Russell and Drew Gysi.
I'm Tim Russell.
And I'm Pastor Drew Gysi.
And we welcome you to episode 127 of the Stewardology Podcast.
This is also why you pay taxes. For the authorities are God's servants who give their full-time governing, give everyone what you owe him. If you owe taxes, pay taxes. If revenue, then revenue. If respect, then respect.
I don't know,
if
Drew.
Honor, oh, we're not doing that?
No. I jumped in too soon. I was about to say, I don't know, Drew. I think I want to tune into a different podcast.
Well, why don't we just keep this thing rolling and not worry about it? And well, we can say honor and honor, but I get you. I know where you're at. So, but then also Jesus said to them, and that previous passage was Romans 13, 6-7. But this next passage, Mark 12, 17, says, Jesus said to them, render unto Caesar the things that are Caesar's, and to God the things that are God's. And I like this next phrase, and they marveled at him.
Today's episode,
yes,
we're going to be talking about 6 common tax mistakes that we see. So why do we talk about tax mistakes on a Biblical Stewardship podcast?
And please answer that question. That is a great question.
Well, because how we spend our money matters.
Yeah.
It matters to God. And frankly, it matters to our testimony. So there are certain individuals who will say that you shouldn't have to pay taxes because it's an authoritarian regime and they're taking it and doing evil, bad things, so you shouldn't pay taxes to the government. Well, so therefore, obviously, taxes in that sense could be certainly very important for us to talk about and discuss. However, I would also encourage you to recognize that when Jesus talked in Mark 12, the passage you just said, he said, render unto Caesar the things that are Caesar, and under God the things that are God's.
Yeah.
And when Paul says, pay your taxes, he was telling you and me, he was telling the people in his day to pay taxes to an organization that was soon going to end both of their lives.
Yeah, well said. Well said.
So it's not about the moral uprightness of that organization, the government itself, as much as it is our testimony before the world as law-abiding citizens who seek the good of the people.
Yeah.
So it matters for us to think about taxes. We should pay what we owe, but here's the deal. I'd rather you pay not a penny more than you actually owe.
That's in the Greek subscript. I know you are a Greek scholar. Tim, you are a Greek scholar. I know that.
Scholar saying more than it is, but yeah, I've had a little bit of Greek training. The point, I guess, here is that, look, we're going to spend our time today thinking about how can we help you avoid common mistakes in that results in you paying more money. Why? Why do we want you to do that? Well, because you'll have more cash that you're not spending on taxes that you don't owe. And hopefully you'll use that cash in ways that glorify God.
Amen.
Either through increasing your giving, increasing your saving, paying down your debt, any number of ways that extra money can actually be used for greater good.
Amen. Amen.
All right. So Drew, back to you.
Yeah, I want to jump in and just give some tax information, some stats, some knowledge of what's happening here. So every year, those of us living in America, we have to file and pay our taxes, and it's tied into what our income is. And to say it in a simple way, the U.S. tax code and laws are very, very complicated. As of 2020, the U.S. tax code is 6,871 pages. But when you include the tax regulations and official tax guidance from the IRS, it's more like 75,000 pages long.
Yeah.
That's crazy.
Yeah. And the amazing thing is that number doesn't decrease. It only increases with time.
Yeah. Yeah. Mistakes are very common, and almost always it's inevitable when preparing the document that there's going to be some complexity that you're going to have to deal with.
When you say completing your document, you're referring to your tax return, or you're talking about the tax code?
More so your tax document, tax return. That's what we're talking about.
Got it.
And though there's great complexity in the tax code, many of the common and normal mistakes are surprisingly so simple. Yeah. And Tim, you've actually had a tax business that you ran for years under the umbrella of the financial services, and you have seen and heard of so many mistakes that are out there.
Yes.
The best way to avoid tax errors would be to work with a professional. But if you choose to self-file your taxes using a well-known tax software where you can actually file electronically, that would be a good second option. This episode, we want to walk through and talk through and see those 6 common mistakes that we want to encourage you to avoid this tax season so that you can become an even better steward of what God has entrusted to you. For our goal here is to have you fulfill what the scriptures are saying. Render unto Caesar's what is Caesar's, but as you know, as we've talked about, but not a penny more. So Tim, what is our first thing that we want to talk about when we're talking about these 6 top tax mistakes?
Yeah, well, one of them is actually overlooked tax deductions. Ooh. There are a lot of ways that you can deduct income from your taxable income.
Yeah.
Therefore, having a lower tax bill. So I think before we get into the nuts and bolts of what these overlooked deductions are, we should probably give a very, very brief primer overview of what is the difference between a tax deduction and a tax credit. So a deduction is something whereby you're actually able to reduce the amount of income that gets taxed. Right. So if you have a $5,000 tax deduction, well, that $5,000 that's not being taxed is maybe going to save you 10%, 15, 20% of that number. So maybe that's going to save you $1,000 or $500, right, something along this line. So $5,000 tax deduction is going to save you less than $5,000 in taxes. A credit is different. A credit is actually a payment on your behalf for taxes.
Like that.
So a $5,000 credit would actually reduce your entire tax bill by $5,000.
Always go with the credit.
We're going to be talking about deductions because I think there are some common ways that we miss deductions and that can help reduce our taxes. So we've got 4 here that we like to bring to your attention. The first one is refinancing your mortgage when you pay points. So allow me to explain. When you buy a house and you use a mortgage, oftentimes you are going to look at various rates. Maybe your mortgage broker is going to tell you the rate on a 30-year is whatever percent, 4, 5, 6%. But if you pay a half a point, a full point, then the rate is reduced. A point is essentially 1%. So 1 point is 1%. A half a point is a 0.5%.
Okay.
And what that means is you're essentially buying a lower interest rate by paying interest on the front end. So if you get a 5% mortgage, and you pay a 1%, point or a 1 point, what ends up happening is that you're maybe able to get a 4.75 mortgage instead of a 5.
Gotcha.
Okay. Now, where it comes to a mistake is when it comes to tax filing season, if you don't bring in some of the forms that you had when you purchased the home, your tax preparer may miss the fact that there were actually points that were being paid at closing.
That's interesting.
That you would be able to deduct if you itemize. If you file Schedule A on your tax return, you can itemize and actually reduce your income by the amount of points you've paid.
Tim,
and there are two ways.
That's a great point, Tim, because I don't think many people know that. They actually go for the points. They do that, but they're not sure, or they don't even think that they could get a little bit of a tax break on that.
Yes.
That's great, Tim.
No, I don't want you to go out and pay points just to get a tax break.
Well said.
But if you have to, if it makes sense to, you certainly want to get credit for it.
Absolutely.
The bottom line here is if you buy a house, if you are doing a transaction, you need to be providing the HUD-1. That's the settlement sheet that you have at closing that shows all of the seller expenses and all of the buyer expenses. You need to provide that to your tax preparer because that information, they can take how much you're paying in real estate taxes, like prorated real estate taxes, how much you're paying for this and that. And there are ways that you can use that data to reduce your tax bill.
Love that. What's another one, Tim?
Well, if you have student loans, and sadly, far too many people do, you are able and eligible to take a deduction for student loan interest.
It's the interest only, correct?
That's correct. You're not getting a deduction for the principal,
right?
But you can get a deduction for the amount of interest. Now, there are lots of limitations to this. There's a total dollar amount maximum that you can deduct, and there are income limitations. If you make more than a certain amount of income, you may not be able to deduct it. But if you have student loans and you're making interest payments on it, you should definitely be recording that on your tax return so that you can reduce your income. So let's move on.
Social Security taxes when you pay and you're self-employed. Tim, talk about that.
You're generally not allowed to deduct taxes. However, if I am a business owner. So I'm a business owner and I have employees. And what the government says is that the employee is required to pay half of their Social Security tax, and I, as the employer, am required to pay the other half of their Social Security tax.
Correct.
So 7.5 for them, 7.5 for me.
Correct.
Now, when I pay that 7.5, I get to deduct it because I am the employer. That's an expense to me, and I can write that off on my tax return. So that's a good thing. But what happens if you're self-employed and all 15% of that Social Security is on you? Well, here's the beauty. You're able to deduct half that 7.5% that the employer would normally pay. Since you're the employer, you get to deduct half of that from your federal income tax return. And I think it's helpful to note that in all of these things, we're really focusing on the federal tax, not state tax
important
laws.
Piece. And I think, Tim, next week, we're going to be going deeper and wider on this specific topic.
Yeah.
And because we're in the throes of tax season at this time, so we want to encourage our listeners, don't forget to listen into next week's episode for more as we look over some of these deductions and some other things. But the next thing that we want to kind of transverse to is math errors, especially when people are doing self-preparation.
Yeah.
So some of the things is we hear often is incorrect wages, bank interest, dividends, and other income. These are some of the things that kind of get convoluted. Am I right in saying that, Tim?
One of the things that scares me the most is when I have someone walking off the street, I ask them for a tax return, they pull it out and they hand it to me, and it's done in pencil on paper. No computer. It's all just them handwriting numbers in. And what that means is that they're hand tabulating all of their numbers, and they can make an error. So, for example, if you have 2 W-2s or 3 or 4 or 5 W-2s, that is the income report that you get from your employer.
Right.
And you transverse 2 numbers, right? You put in a 15 instead of a 51. Well, that could be a huge problem because the IRS also gets that W-2.
Right.
And they know the actual number and they're calculating it through using the actual numbers. There's no chance of having a math error there. Mm-hmm. They're going to send you a notice. Hey, dummy, you told me you made $15,000. You made $51,000. You owe taxes.
Right.
And here's some penalties too.
Yeah. Yeah.
So it's not just on income. It could be on charitable deductions. It could be on your tax payments, your estimated tax payments. It could be on 1099s, any number of things.
Anything that's
you have
errored.
to add together. You could have a fat finger error, right?
Yeah.
Just hit the wrong button on your calculator and come up with the wrong answer.
Tim, I have vivid memories. Now, when I was a child, we did not have all the tax software. Computers didn't come into play until the 80s pretty much. But when I was much younger, if I grew up in the 70s and early 80s, I have vivid memories of my dad sitting at the dining room table with papers sprawn all over during tax season and a calculator, and he is there trying to calculate and run all these numbers. It's imprinted in my mind. And the days that tax software came into play, that was a godsend because it really helped kind of change the way people were doing things. But you still need to punch in the numbers in the right way.
Absolutely. Absolutely. And there can still be math errors when you're inputting numbers into a computer system. It's garbage in, garbage out. If you put in the wrong information, then you're going to have a problem. Another thing that we see is that when you're sitting down at a computer screen and you're typing in different things, if you don't understand what exactly they're asking for, you're going to put the information in the wrong category. This is not exactly the same as a math error, but it kind of goes to the whole idea of you really do need to understand what it is that they're asking for. Even if you use something like a TurboTax or whatever, they're going to ask you, did you have this? And if you don't know what this means, you're probably going to have the wrong kind of experience, the wrong kind of answer.
One thing I learned in my early years of doing taxes is you need to have documentation for your numbers. Yeah. You got to back it up.
Yep.
And you can't just kind of pull numbers out of the air. And
you can, but if you get audited, you're in trouble.
You're in big trouble, yeah. So, but it's good to have the documentation for your numbers and understand it's not a fatal error, but it could cause you a lot of confusion and frustration and time and money.
So let me just back up. Yeah. Making math errors is a non-fatal error.
Correct.
Because that's something you can always amend and fix. It's not a morality issue. It's not kind of tax fraud.
Exactly.
There may be a penalty involved, and the bigger the numbers are, the bigger the penalty. But that's not something you're going to jail over.
No.
You don't have to worry about that necessarily. You do need to make sure you put in the right number. So you have to be careful. When I joked earlier and said, well, yeah, you can make up any number you want out of thin air. I said that in terms of one's ability, not one's moral obligation or right.
Yes.
You don't have the right to just make up your own numbers and throw them in there.
Yeah.
Because God sees your tax return.
Amen.
And you can't cheat God. He knows what's going on. He's a lot smarter than any IRS pencil pusher.
Yeah. Yeah.
And he's got his ways of dealing with us in our rebellion. So pay attention to that.
So it's very important if you're doing the self-prepared part, make sure you have documentation for your numbers. If you do transpose a number and you do need to give record of that information, you can easily go back, pull that information out, have the receipts and or data that you can pull out to actually bring that correction. And Tim, you talked about a moment ago, really it's an integrity issue.
Yes.
And you're reporting the numbers. That's the key thing. Proverbs 10:9 says this, the man of integrity walks securely, but he who takes crooked paths will be found out. Tim, that's just what you said. And I think it's important for even in our tax preparation, our tax return, that we operate with integrity.
Quick story. I was dealing with a local small business. These guys were not believers, but neat guys. We liked them. We actually liked the restaurant they were going to. It was a cash business, and they were trying to sell their business, and they knew they made buku dollars. The problem is they weren't showing it. It was all cash.
Wow.
So they didn't report all of their income. They reported like a tenth of their income. And so they were frustrated and a little bit angry when they couldn't get the buyer to pay what they wanted for the business because they actually cheated themselves because they had no documentation of the income that they actually generated.
Wow.
Well, look, it's always going to come back to bite you one way or another.
Yeah.
Just tell the truth.
So let's not fudge the numbers, embellish numbers on your tax return. But as Scripture states, let's all be listeners to this episode and be people of integrity, people that walk securely. So we don't go down those crooked paths and be found out and damage, most of all, the name of our Lord and Savior.
Yep.
But let's jump in. Let's talk about forgetting important paperwork.
This is the third mistake.
The third mistake.
Important paperwork.
Being forgetful is totally different than misrepresenting the numbers on your tax return. Would you agree with me, Tim, on that?
Yeah. It's not just forgetful. Like you could lose something. You could. There's any number of ways that innocently information could not show up on your tax return, and it's going to cause problems. Because in many cases, those important papers, those important numbers are often also reported to the IRS.
Yeah.
And if you don't report it and the IRS is expecting it, you're going to get a notice from the IRS and they're going to say, hey, buddy, we actually see that you earned this. So, prove us wrong.
One thing I learned about this forgetting is what happens more often when people file prematurely. They basically, as soon as they think they have all the documentation, as soon as they think they do, they go and they file. And then all of a sudden, other numbers come their way.
Yep.
That becomes a challenge.
Yep.
Am I right, Tim?
Yep. No, that's absolutely correct. So if you, if you get all your information in and later there's this 1099R or 1099 DIV or whatever that comes in that you weren't expecting, and maybe, you're so busy, you're not looking for tax documents anymore, you're going to forget to even report it. Well, the government gets that.
They get a copy.
They're going to let you know.
Yeah.
And it may involve penalties and taxes and all kinds of other frustrations.
Yeah. And I think it's important, if you're going to be doing self-preparation or even gathering all that information for your preparer, have a portal, have a location, have something that you can put all those documents in, and then maybe even create your own little checklist, because maybe year after year, if there's nothing major changing, you can check those boxes. I got this form. I got that form. My wife and I actually do that to a degree. We know the forms. We know the documentations that we should be receiving, and we say, okay, we don't have this one. Get online. Let's get this one.
Yep.
So I think that's important. Tim, talk us through some of the forms that are out there. You've just shared a few of them, 1099R. Explain what that is.
Most of the 1099s are the ones that we're going to be talking about. There are a couple of extras. A 1099 is an income reporting form. So there are 1099Rs. You get those for retirement accounts.
That's why they have it. R
for retirement. So
move.
If you take income from a retirement account, you're going to get a 1099. It's going to show how much was taken, how much of that you took was actually taxable, because not always taxable,
right?
And how much taxes was withheld and then sent to the appropriate agency, whether it's the federal government, the state, or the local government. 1099Rs can easily be missed. And obviously, they will have a direct tax impact, potentially.
Give us, if you have something off the top of your head, give us the impact it could make.
If you forget a 1099R and you are retired, you're collecting Social Security, the amount of your income that you receive will impact the amount of Social Security that's included in your taxable income.
Okay.
So I don't know if you're aware of this, but let's say you earn $10,000 of Social Security income, and all of the other numbers are either large or small. Well, you could have none of that $10,000 slide over to the box that says it's taxable, because your income is low enough. Or if you have more income, you could have up to 85% of that number, $8,500, slide over into the taxable portion.
Oh.
Okay, so here we have a situation where someone's on the bubble.
Mm-hmm.
And they don't report a 1099 because they miss it or they forget about it. And it's like a $30,000 distribution. Well, by not reporting it, it shows none of that Social Security is taxable.
Right.
But the minute that shows up, yes, not only do they have the tax on that $30,000, but it causes an additional up to $8,500 of Social Security to also be added to your tax burden. That can create a disproportionately large impact on your actual functional tax bill.
Tim, you said it so well. So that's a critical piece. What's a 1099-B?
Okay, 1099-B deals with sales of stocks or mutual funds. So if I hold a portfolio of mutual funds that are not held in an IRA, these are individually held, that's in my name alone or me and my wife, not inside our IRAs or Roth IRAs or 401ks. Those funds, if we buy and sell inside the year, we're only responsible for the gain or loss on each individual position. So if I buy it for $10 and sell it for $15, I have a $5 per share gain. That's reported on the 1099-B. There's another problem with 1099-Bs, though. Some 1099-Bs report no cost basis. So you buy it for 10, you sell it for 15, but the 1099 may report that you actually paid 0 for it.
And that can radically impact your taxes.
Well, absolutely it will. And this often happens, and the IRS always catches it and assumes that you paid 0 for it.
Yeah.
Therefore, it's all taxable to you.
Wow.
So what they're going to do is they're going to send you a notice that there's all this additional income for mutual funds that you sold. You didn't report it, and we think it's all taxable income.
Wow.
The reality is you have to go back and create your cost basis, figure out what that basis is, what did you pay for it, and then report that to the government and get a correct number. Just because the government knows you had a 1099 in income, they don't know how much of that income was actually taxable, and they're going to assume a worst case scenario.
Tim, I so appreciate you sharing that. Now, if someone like myself, I'm working with a financial advisor and I go through this and I'm doing a sale of something, is that something that the financial firm can actually provide for me? Or is that something I need to figure out myself?
You mean the cost basis?
The cost basis, yes, thank you.
So the answer is it's complicated.
I figured you were going to go there.
And the reason it's complicated is because there are legal requirements and there are compliance requirements that can make it a little bit difficult. First of all, yes, the financial advisory firm, if they had the account during the entire time frame when you bought it to when you sold it, they can go back and see every purchase you've made and help you recreate some of that cost basis.
Sure.
So they can gain access to that information, but many broker dealers, many compliance officers do not want a financial advisor to become a tax preparer or to create cost basis, because they can make a mistake or an error, and they might be liable. It might come back to their E&O insurance and all of the rest. On the flip side, there's also a legal aspect. Up until, I'm going to get the date wrong, but it's probably something like 2011 or 2012, cost basis was not required to be held or kept by the custodian. So if you buy and sell shares at Charles Schwab, they weren't required to track the basis and report it on the sale.
Interesting.
They expected you to do that.
Wow.
And the law changed where they're now required to provide it. Here's the problem. If you've bought shares prior to that law change, there's no cost basis tracking going on there. Now, they probably will be able to generate something and tell you what it is, but it's not going to be reported on the 1099. Therefore, you can't just assume the 1099 is accurate for that 1099-B. Look at the number and just try to remember, did I actually pay that much or that little for that stock? This doesn't seem right. Go back, look at the transactions. Just make sure you're not paying taxes twice for some of that income.
Well said. 1099 INT.
Yeah, what is that? We haven't had interest in years, it seems. Well, it's INT.
Wait. We're getting it now. We're getting a little bit now. A little bit.
Only if you have a high-yield savings account.
Correct.
My friends, open a high-yield savings account.
Amen.
Get yourself a 1099 INT. It'll feel so good. Well, I joke. Look, a 1099 INT is an interest reporting statement. When you have $10 or more of interest, the bank or financial institution is required to send a 1099 to you. For years, people have had money in savings accounts with like next to zero interest. Like they may have 3 cents of interest all year long. It's ridiculous.
Yes.
It's embarrassing. Well, when you open up something like a high yield savings account and all of a sudden you're getting a 3.5 or 3.4% interest rate, you're going to start collecting a bit more of interest.
Yeah.
You do have to report that. I would much rather report and pay taxes on a little bit of income than not have any income at all.
Right. Yeah. 1099 DIV.
Those are for dividends.
Yes.
Surprising, right?
I'm loving how they're making this so simple to understand.
Occasionally they do. So
Occasionally.
the dividend, right? The dividend piece is if I've got a stock, if I've got a mutual fund and that mutual fund pays a dividend, I'm required to report that. The government gets that information from the mutual fund company, and then I have to pay taxes on it.
So the government gets a copy, but you personally get a copy.
Yes.
So you need to make sure that either you as the tax preparer or your person that's preparing your taxes has that 1099 DIV.
Absolutely.
K1.
K1 is for partnerships or businesses or estates. So if you are involved, an owner, or have beneficial interest in a trust, an estate, some kind of a partnership or business like an S Corp or something like that, the income is passed through to you on what's called a K1. Here's the real problem with K1s. K1s do not come out early in the year. You'll get a 1099 like R by mid-February.
Correct.
You'll get a W-2 by the end of January.
Right.
But the K-1 doesn't have to come out until after the business reporting cycle. So, for instance, a business has a different tax deadline than an individual. You and I, we have to report our taxes usually by April 15th of any given year. Well, it's actually March 15th for a business.
Is it really?
Yeah. So a business then has to get all their information in and get the tax preparer to create that tax return and then report the K1. The problem also is that many businesses can't get it all done in time, and therefore they extend their return, which means they don't have a K1 to provide to the owners.
Ouch.
And what that then means is if the owner's not paying attention and files the tax return without that K1, they're going to get a K1, the government's going to get a K1, and then they're going to get a notice. Or they're going to have to go amend their return to include the income from the K1 on their tax return.
So in that scenario, I presume that the business will do an extension and the owner will do an extension also.
Correct.
Am I correct?
Yes, that's correct.
Yeah. 1098E.
Okay, E. E stands for, I have no idea, student loans. So it's for, E is for education. It's for interest on student loans. So this is where we talked about earlier. Yeah, if you don't have that, then you're not going to be able to deduct that income.
So it's very helpful to have a running tab of every institution that you may receive any tax forms from. So we just want to encourage our listeners, if you haven't done this in the past, build out a document while you're doing things this year and then be able to have that, reuse it next year, and then you can check box everything that you have so that next year you're not going to miss anything and you'll be up to speed on things. Let's look at number 4.
Number 4 is interesting. We've actually already talked about this, so we're going to be able to skip by this probably fairly quickly.
Yes.
But it's paying too much in capital gains taxes.
Yes.
Now, we did in some regards, and there's some more that we should go into the capital gains tax world for you to understand. The first thing to understand is what on earth is a capital gain? So there are actually 4 different kinds of ways of looking at this. There's long-term and short-term.
Okay.
Long-term is for shares that you've purchased and held for more than 1 year. It's got to be 1 year and a day.
So long-term is 1
for
year
you to
and
get
beyond.
long-term treatment. Short-term is for anything less than 1 year and a day. So 1 year and under.
364 days or less.
65.
365 or less.
366, you're in good shape.
Gotcha.
All right. Yeah, that was nerdy. Okay. So that's one way of looking at it. We have long-term and short-term. The other thing we have to look at is whether it's a gain or a loss. You could have a short-term gain or a short-term loss, a long-term gain or a long-term loss. As you know, if I buy a stock at $5 and I sell it for $10, I've got a $5 gain. But what happens if I buy it at $5 and I sell it at $2.50? Well, that's a $2.50 per share loss.
Yeah.
Now, I can write that loss off, or I can use that loss to offset other gains. So if I have more gains, we have to pay taxes on those gains. Here's the beautiful thing. For those individuals who are married and who earn less than $85,250, this is for 2023, they have a 0 capital gains tax rate. That's nice.
That is nice.
So if you have a small gain that doesn't push you over that threshold, then your tax burden on that gain is actually going to be 0. You don't have to pay taxes on it. So be aware of the tax bracket you're in. If for an individual who is unmarried or filing as an individual, that number drops to $44,625. You'll see a table for this in the show notes here, so you can go take a look at that. The other thing to be aware of, and this is something I run into from time to time. Not only do we have the issue with 1099Bs not reporting capital gains, or cost basis. You have to go and recreate that. Another way you can get into problems is in an inheritance situation. Drew, you and your wife have saved and invested. You have a joint portfolio, and it's $250,000. You paid $100,000 for it. It's now worth $250,000. If you were to sell it today, you'd have $150,000 of capital gains, and yes, you would pay tax on that because it would push you over the $89,000 limit.
Correct.
Okay. So what happens if you pass away? Well, if you pass away, your cost basis, your wife, her cost basis changes. She gets a stepped up cost basis for half of that account. So if it was $150,000 of gain at the time of your death, she gets her cost basis adjusts by $75,000. $75,000 is half of 150.
Nice.
So you have 75 and she has 75 worth of that gain, but at death there's a step up in cost basis. The basis for your half jumps all the way up to the full value of those shares at the time of your death. When she passes away, let's just pretend for a minute that it continues to grow. You as a married couple paid 100. It's now worth 300. Your children would inherit it from your wife, and they would receive a stepped up cost basis to the value of the shares or the stock on the date of your death, her death.
Interesting.
So instead of the children paying $200,000 in worth of capital gains, they would actually be able to sell it shortly thereafter your death and pay taxes or take a loss on the difference from the sale, the date of the sale, and your date of death. If it went up a little bit from then you'd have to pay a little bit of tax on that. If it went down, you get a loss.
Nice.
The problem is the 1099B is not going to report the value or the cost basis on the date of your death.
You have to
go back and report that. You have to go and create that information, gain that, provide it to your tax preparer, or have your tax preparer get that information so that you can pay the appropriate amount of taxes. I have seen several times where I'm working with a tax preparer. We've got a death in a family, and the tax preparer they know about the death, they know about the rule, but in the heat of tax season, they forget about it.
Yeah.
And they have the client pay all of these taxes. And I sit down with the client and I said, hey, how'd it go? Oh, my word, my tax bill was so big this year. Well, it shouldn't have been that big. Let me take a look at your tax return. I look at the return and I say, where did all this capital gain come from? You shouldn't have had this. And then I go back and dig a little deeper and find out they didn't take the step up in cost basis. You paid too much tax. So when there's a death, be aware, step up in cost basis is a big way of reducing your tax bill.
Now, in that scenario that you just shared, somebody could go and amend their tax return and get that corrected.
And in this case, we did. Yes, we amended it. They got a big refund.
Just wanted to make sure that that was available to them. Let's look at number 5, filing as the wrong status. And it says that you could qualify to file under multiple statuses, but you got to know which one's going to be you're going to be able to benefit the most from. Tim, talk to us a little bit about this.
I see this as a mistake. I don't see this as a very common mistake.
Okay.
If you're single, you can't file married joint.
I think that's pretty common.
You can't file some of the other statuses. So single is single. That's pretty simple. A married person can file as married joint or married filing separate.
So those are two different categories.
That's right. The problem is, or you can even do married head of house. The problem is there's almost never a benefit for a married couple to file married joint. Or I'm sorry, married separate. Married joint is almost always the better way to go.
Really?
Yes. So when you do, and you can look at the tax brackets. We'll include probably in our show notes either a link or a table for the current tax tables, and you can look at the tax tables for that married separate versus married joint, and it doesn't make any sense to do it. You have higher tax brackets. You lose your ability to deduct IRA. You lose your ability to make Roth and traditional IRA contributions very quickly. It just creates all these extra complications, even for couples that are going through a divorce. As long as they can amicably get together and file their taxes together and figure out what to do with the refund and how much who gets what.
Yeah.
I know that can be complicated and difficult. It's financially more advantageous for them to do it married joint than married separate.
Yeah.
Sometimes it just has to be that way. And if it is, it is. And that's just, I'm sorry, it just is the way it is. We get through it and life moves on. But where we can, do married joint. There is another category. It's qualified widower, and that's for someone who has lost a spouse and who has minor children, and only for the first year after death.
Oh, for 1 year only.
Yeah. So that's a very rare occasion. Like that's so very few people can actually file for that. I don't see mistakes with people actually filing for that when they can't. Although I can imagine there are people who don't file that status that could.
But if they could, there may be some key tax breaks or benefits for that 1 year.
Absolutely.
So take advantage of that.
Absolutely. Yes.
Yeah. So, Tim, talk to us a little bit about how tax brackets work. Being in a tax bracket doesn't mean that you pay that federal income tax rate on everything that you make. So kind of explain how that works, because I'll be honest, this is new to me. Yeah. I didn't understand this.
So I'll meet with a couple and I'll look at the tax return and I'll look at them and say, okay, great job. You guys made $120,000 last year. That's wonderful. Out of curiosity, how much tax do you think you're paying? Percentage. And they look at me and usually they have like a complete blank look on their face. Like, I have no idea. I'm like, well, what do you think? 10%, 15, 20, 30%? Oh, I made 120. I have to be 20%. Oh, okay. So I take their tax return and flip it over to the second page of the 1040. And I said, you paid $8,500 in taxes. What percent of 120 is 20%? Well, I mean, that's $24,000.
Right.
You paid $8,500. You're doing great. So the question is, why?
Yes.
Why did you pay so little when you are, you're making good money? You should be in a higher bracket. Well, the answer is we have a marginal tax rate system. Just because you happen to get bumped into one of the higher brackets, and maybe we should talk about what exactly those brackets are. We'll have this in the show notes, but we have a 10%, 12%, 22, 24, 32, 35, and 37% bracket. If you go from the 22 bracket all the way up to the 24 bracket, well, that's only a 2% difference. But the crazy thing is all of your income is not taxed at 24. For a married couple, the top end of 22 is $190,000. Well, what if you make 191? Mm-hmm. Am I now paying 24 on everything? No. The answer is you're only paying 24 just in that little itty bitty bit that went above the 22% bracket. So for the first $22,000 of income for a married couple filing jointly, they're taxed at 10%.
Okay.
And for the next 22 to up to $89,000, they pay 12%. Mm-hmm. 22% is from 89 all the way up to 190. So only the income that falls in that bracket is taxed. Oh, but wait, there's more. It's not just how much income I made, plug it into the table. It's how much income I made that's actually taxable, because you
important.
Get a standard deduction or an itemized deduction. What is a standard deduction? Well, a standard deduction could be something like, for a single individual, it's $13,850 for 2023.
Okay.
A married couple, we're looking at $27,700. Mm-hmm. So if you made $120, that's your adjusted gross income. And then you reduce it by your married filing joint standard deduction of $27,700. Now we're in the 90s. Mm-hmm. And then you take that number, the 90-some $1,000, and you plug that into the tax table.
Nice.
So your tax rate actually is somewhat reduced.
Nice. I've heard the term used, we have a progressive tax system.
That's correct.
Would you agree with that?
Yeah, that's what it is. Because the tax progresses higher as you go. And it's a beautiful thing, because the jump between 24 and the next bracket is 8%. So to go from 22 to 24, it's only a 2% jump.
Right. But
to go from 24 to 32, that's a big jump.
It is.
And you would think that if I make just a little bit more, all of a sudden I've got to pay 8% on all of my income. That would be a great hardship. It actually is not a great hardship, because it's a progressive system and you're only taxed that higher rate, 8%, only on the income that falls in that bracket.
And the amazing thing is, our tax software today and our tax preparers and the software they use, because everything's computer generated now, it picks up on all that stuff. It knows all that stuff, and it adjusts it accordingly, as long as the numbers are punched in accordingly.
Absolutely.
So that's wonderful. So let's jump in. Let's talk about entering wrong personal and bank information. And I have a little story about this. But Tim, let's talk about this. We already touched a little bit about this, about wrong personal or bank information, but explain.
Well, I mean, if you enter the wrong social security number, you invert two numbers, you might be filing on a dead person or on someone else that, has filed.
Well,
or
if somebody out there owes, just reach out, or not owes. They were going to get a refund, reach out. I'd be glad to give them my social security number.
Yeah, the problem is you can't then file your return, because you can't double file on a single
bummer.
Bummer social security number.
Well, put it this way: if it's more than what I'm going to pay or get back, I'd like to talk to you.
The problem again, Drew, is if they put their routing and account number in there, it's going to them, not to you, even if they use your social security number.
Well, we got to be legal, ethical, and moral.
Drew, all your schemes.
I'm telling you.
The other factor here is, like I said, if you type in the wrong social security number, that person can't file their tax return electronically. Yeah. They would have to file their tax return in paper format. And I don't know if you know this, but the IRS is like 3 years behind in filing paper tax returns. They've got rooms and truckloads of tax returns that simply haven't been processed because we have an incompetent. No, I should probably rephrase that. The IRS is grossly understaffed, and they have a horribly antiquated technology stack.
Yeah.
Because of those two factors, understaffing and really poor technology, they cannot process those paper returns in any fast or efficient manner.
Yeah.
Therefore, I hate to say this, we do need more agents, more social security, more tax individuals to process those returns and to answer questions and to resolve problems.
Yeah.
I'm not really a big fan of people going after a bunch of law-abiding citizens and trying to, imagine and make up ways in which they owe more taxes. I don't like witch hunts, but I do like getting your tax liability taken care of and resolved. If you're on the phone for the IRS for like 5 hours to get an answer to a simple yes or no question, that's just terrible use of everyone's time and resources. Yeah. And then when you do have a problem, a legitimate problem, Drew, like your story, you can share in a minute, we've got months and years it takes to actually resolve that problem. Drew, why don't you talk to us about that?
Yeah, my daughter, she moved from just literally 30 miles and did her tax return, or actually had her tax return done. And there was a error in her current home where she was living, and I also believe there was an error in her routing number for her bank account, and it was a double whammy for her, and that double whammy literally took 14 plus months to get straightened out. Countless hours on the phone trying to get through to somebody. So something very simple can hold up. And she was getting a decent sized return. It held up that full amount of money for a very long time. And she needed that cash flow because she was a student in graduate school at the time. So I can't stress this enough. Check, recheck, and triple check to make sure some of those key numbers are correct.
Absolutely.
Tax planning is one of those ways that you and I can become an even better steward. We here at the Stewardology Podcast, we are passionate about making sure that we and even you will render under Caesar's what is Caesar's, but as we say, not a penny more. If you successfully do the same, then you will have more pennies, more dollars, even hundreds of dollars to better take care of your family, invest more in kingdom work through your church so that you can become an even greater steward and be able to give more generously unto the Lord's work to see greater kingdom impact happen.
Drew, I think there's one or two more things that bear saying from a biblical perspective. The fact that you owe taxes is a testament to the provision of the Lord.
Amen.
I would rather you owed $1 million in taxes, because think about the income that you would have had for that and what you could have done with that.
Tim, say that again, because I don't think people feel that way about it, but I think they need to hear this.
Yeah, taxes are a sign of God's blessing and provision. When you pay your tax bill, rather than being angry at the government, we should be grateful to a God who gives us the income that puts us in a position where we actually owe these taxes.
Yes.
Rather than grumpiness, we should be grateful.
Yes.
Grateful to God, not grateful necessarily to government, but grateful to God for how he has abundantly provided.
Tim, that's a game changer to be able to process it as a gratefulness to God. And I mean, we all agree. A lot of government misspending and overspending and all those other things. And we can be upset about that because they're misusing our tax dollars. But Tim, that doesn't change the fact of what you just said, being grateful to God that we have had the income to be able to provide for our family and even take care of some kingdom work that we are passionate about. I think that is a very solid and good takeaway point at the end of this time.
Yeah. So that's all I have, Drew. I'll save my last thought for the very end.
For the very end. So we just want to say thank you for joining us on this episode of the Stewardology Podcast. Don't forget, We want to hear your questions, your comments, and your thoughts. Go to stewardologypodcast.com/idea and take advantage of our free personal stewardship reviews. Many have. We've been busy recently in a good way. So with that in mind, take advantage of that. Learn how you can take those next steps to become an even better steward. How do you do that? Go to stewardologypodcast.com/review. Consider giving us a review where you listen to this podcast, whether it's Apple, Spotify, Amazon, Google, etc. So go there, give us a review. We read those things when we see them come into our inbox.
Yeah.
And visit our website. Tim actually mentioned quite a few times, we got some show notes sitting there specifically on the show, some links and some other charts that are there. So jump on there, go to stewardologypodcast.com for those resources and show notes, etc.
Well, thank you for joining us in today's episode of Stewardology Podcast. Until next time, take care, God bless, and please, 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 please do not forget, when you're paying your taxes, trust in the Lord with all your heart. Do not lean on your own understanding. In all your ways acknowledge him, and he will make your path straight. Do not be wise in your own eyes. Fear the Lord and turn away from evil. It will be healing to your flesh and refreshment to your bones. God bless.
Thank you for joining us on the Stewardology Podcast, where financial stewardship and theology meet. We'd like to help you take your next steps in biblical financial stewardship. First, subscribe in your podcast provider to get the newest episode delivered to you every week. Next, follow us on social media and visit our website at stewardologypodcast.com. There you can find our social media links and our entire episode archive. Remember, some trust in chariots and some trust in horses, but we trust in the name of the Lord our God. See you next week on the Stewardology Podcast. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.